Hi, this is Geoffrey Dohrmann, Chairman and CEO of Institutional Real Estate, Inc. I'd like to welcome you all to our third quarter 2022 ODCE Index Update webinar. Thanks for joining us. Throughout the webinar, as always, you can pose questions for our presenter at any time by clicking on the Q&A icon at the lower right-hand corner of your window and entering your questions. You can do that either as yourself, in which case I'll recognize you as the source when I pose your questions to our presenter, or you can pose your questions anonymously if you prefer not to be acknowledged or identified. Either way is fine with us. And either way, we'll try to respond to as many of those questions as we can. In the past, we've been able to field all of them. So it's a wonderful chance for you to get your questions asked and make sure that you get exactly what you came to get out of the webinar. Also keep in mind that we're going to be recording this session. So if one of you or your colleagues wants to review the recording later, it'll be available in a few days. In fact, we'll be sending you a link to the recording in a few days of closing the session. So what's this all about? And why are we doing these quarterly updates? I like to cover that because we always have a few new people that haven't been to these before. I know that many of you investors and investment managers sitting in on the webcast have been benchmarking the performance of your investment portfolios against the ODCE Index for some time now. And I know that some of the private wealth advisors that are tuning in most likely have been in search of a suitable benchmark to evaluate the performance of the real estate investment vehicles they've been recommending to their clients. And the ODCE Index just might be the appropriate solution for those advisors and their clients. Consequently, it only made sense that we should find someone to partner with us to help provide some insights on how those numbers have been changing over time and what any shifts in those numbers might mean on a quarter-to-quarter basis to people that are using it as a benchmark. And the partner we found is IDR, the manager of two open and ODCE Index funds, one for institutional investors and one for accredited high net worth investors that seeks to track the performance of ODCE by a margin of plus or minus 12 basis points. Prior to the creation of ODCE, most of you benchmarked to the NFI property indices. And the problem everybody talked about with that is that it wasn't an investable benchmark. With the creation of ODCE, it's now possible to invest in an ODCE Index investment vehicle, which means it's now possible for investors to index all or a portion of the real estate investment portfolio, just as they've been able to do in their equities and fixed income portfolios. And they can do this either by constructing or asking their investment managers or consultants to construct exposures to the open-end funds that make up the index to mirror the composition of ODCE, or they can invest in a vehicle like the ones that are being developed by IDR. The portfolio manager for IDR's two funds is Garrett Zdolshek. Many of you have been tuning in or well aware of that, who prior to joining IDR was a senior consultant with Cortland Partners, which is now part of Stepstone. And at Cortland, Garrett was a member of the investment committee and participated in all decisions relating to investment program and investment manager selection and performance measurement. So I can't think of anybody who's more qualified to comment on what's going on in these quarterly updates. So Garrett, the floor is yours.
Thanks, Jeff. As always, a pleasure to be here. And, I just echo your statements about questions. And, we may kind of defer a few as we get to certain points in time, but love to hear questions, what's on everyone's minds. And that's why we do this. So, please ask questions as we go. I will try to follow somewhat of a similar format. But it did add a few new things here. So maybe I'll kind of jump right into it with the agenda and kind of what we're thinking. So, each quarter, Jeff, your team asks, what's the title? What are we going to call this? And we always have to come up with, a couple words or, a name. And, this quarter, I really couldn't think of anything kind of more appropriate than values, liquidity, and fundamentals, because those are the top three questions. I think we're asked by everyone from investors to even fund managers, portfolio managers, all across the board. I think we're all thinking about that today. A lot in the news, certainly, about the markets. So, with that, I'm going to kind of follow a similar topic overview. We'll start with kind of where we are today. I know this is 3Q data. But I'm really going to try to put things in perspective because we are at the end of the year. and thinking about especially where are we relative to the cycle. And we thought kind of going back to pre-COVID was an interesting exercise to look at really what the cycle looked like over the past 3 years, before we got into this, and what's it going to look like going forward. So fundamentals, I think, are a great way to kind of think about where we are today, what that means, from an income and return perspective, before value appreciation or depreciation. And then finally, I think everyone's kind of favorite, we always hold it for last, but where we're going. Capital flows certainly kind of tell us, what people and what investors think about values, what they think about the outlook, but also looking into the transaction volume and what's happening, on the ground within the real estate market as well. So without much more delay, I'm going to jump right into kind of the market overview as we usually do. Not a lot has changed from second quarter to third quarter at the top line numbers. Added some properties. Occupancy remains incredibly strong. And this has changed for the past year, by the way. Mentioned one fund left the index earlier in the year, so we had 26 funds. And leverage actually slightly down, so down to 21%. The sectors, and we'll talk more about this, again, no surprise over the past year, industrial leads the way, followed by apartment. But I think other, even though it's a small percentage, is really gaining a lot of steam. And that's where we see a lot happening today. And I think where a lot of outlook is kind of focused. From a regional standpoint, I mentioned this in the past, but, the West, for all we think about maybe California losing population to some of these other markets, it's simply incredibly strong. So the West remains really strong. The East obviously is losing population to the South, and in the Midwest as well. So, I think this will remain much more steady over the next year or so. I've shown the changes in property types in the past. Certainly lost a lot of office exposure in the yellow line and gained a lot of industrial. So about 14% industrial change over the past year. But a couple investors asked us, and actually managers said, yeah, but how much of this is purposeful? Like, is this happening on purpose? How much is the index changing overall? And I thought that was a pretty interesting question. So kind of went back and looked at the change in sector allocation. How much of it was because of net buying and selling versus just value change? Because when the value of industrial goes up, it's bigger percentage of the index, right? And this was really surprising to us. 80% of this value change, or 80% of the weighting change has come from value change alone. So just the appreciation and depreciation has really driven that big sector shift. And which is why it's, I think, so hard, investors mention it's so hard to maintain our weightings and our exposures. Because if you don't have it going into these cycles, it's a lot harder to buy and kind of catch up, if you will. So I thought this was a pretty interesting explanation of, how these things are changing so quick and why it is so difficult sometimes to catch up. I kind of mentioned too the kind of looking at things 3 years ago, pre-COVID to today. This is the first slide I'll show on that, but we hear a lot about denominator effect affecting real estate allocations today, and so wanted to look at the S&P is certainly 50% plus equities in many investor portfolios, huge driver of that. I left the bond line off of this just because it's basically slightly down, but pretty flat. So it hasn't changed all that much. But and then certainly REITs, are down, and we've talked about that in the past. But this gives you, I think, a fair view of where ODCE is relative, to the equity markets. What also surprised me a bit was this rally. You can kind of see from the third quarter to today. So obviously ODCE ends at the third quarter valuation, but it's really been a pretty good quarter so far. X today, I think it looked pretty ugly this morning, but so far this fourth quarter has actually brought values back, fairly strong from an equity perspective. We'll see if it holds. Certainly, but the S&P was down 24% year to date as of the end of the third quarter, and as of yesterday it was down 15% year to date. So it came back about 9% this past quarter. That'll certainly help the denominator effect. I think we'll talk more about values. Obviously, they're probably going to go down a bit here or more. We don't know. But, certainly, I think that the narrowing of the gap will happen in a couple ways, potentially with equities rebounding, values adjusting in ODCE, and there might not be nearly as big of a gap as we think today, potentially.
One of the arguments that people sometimes make is that the NAREIT index, or REITs, tend to be proactive in their pricing, and that they tend to lead, whereas ODCE tends to lag. But when you look at this chart, it looks a lot more to me like REIT performance has pretty much mirrored the performance of the S&P, at least during this particular cycle.
Yeah, look. So when you look at correlations, REITs are really highly correlated to equities, right? The equity market is based on forward-looking values of what people think will happen. Sometimes they're right, sometimes they're not, right? But it's a clear bid-ask, and the market equalizes every day. The ODCE market is much more of a backward-looking view on values, and so it doesn't equalize every day because sometimes there's more buyers and sometimes there's more sellers, but the price is, if you will, posted. So completely different views on value, and sometimes you see they do cross. Sometimes REITs tend to be further ahead, just on in a way too, on both cases. I don't view them as a great proxy for private values either, but they can kind of tell you the market sentiment and where the market at least views things.
We have a question also that came in, Garrett. It says industrial and apartments now make up about 60% of ODCE. Do you anticipate those allocations to continue increasing going forward? Or do you think fund managers have reached target ratings in those particular sectors?
Yeah, so I would say this, if you look at how fast they changed, and I'll actually go back here. If you look at how fast these weightings changed, again, think about a lot of it came from value change. And I'll talk about values and performance over the last 3 years here in a minute by sector. But, that would tell you there was a huge there was a huge divergence between the performance of the, industrial, for example, and office or retail. So I think a lot of this weighting change, again, came just from the values, 80% of it. And then the rest kind of came from buying or selling. So I think trend-wise, it'll continue a bit, but you can already see it, with lower returns coming in this quarter. I mean, they've really leveled off. They're not moving, very much. So I think they really will level off for a while. But I would also say, we can, and we'll talk more about what is being bought and sold. I think the other, if I have to put one place, I think will really grow. I think there's a lot more focus on other, and a lot of focus on, value creation going forward, which is really strong fundamentals. Where will operating income grow? because we got to go back to making returns the hard way, which is, growing income, not just seeing cap rate compression and values go up.
Now, another question is, looking at different sectors, is there any sector that whose values adjust quicker than others?
That's a great question. And I would tell you, I don't think so without seeing more research. You could argue maybe the bigger sectors are more liquid. So you see more transactions in the traditional, office. But beyond that, I think the appraisers are really focused on trying to value everything evenly, as they can.
And there were two other questions related to things I think you're going to cover later. One is, how is the liquidity for ODCE funds? And the second is, how have redemption and contribution queues evolved over the course of the year? And what is the net balance as of Q3 today? You're going to cover that later, aren't you?
Yeah, that's the last section. We'll cover that in detail for sure.
Okay, so if the person that asked that question, has a clarifying question, they can ask it when we get to that part, okay? So Kevin Stone also had a question. He said, assuming you will look at income returns here in a second, but why has the income returns come down in the ODCE?
Yeah, so on a mark-to-market basis, it's just a simple function of the market got more expensive. So, this is looking at a going-in yield every quarter. Whereas if you bought a year ago, your income has actually gone up. You just, the cash you're receiving every quarter has gone up, but the value has gone up. So from a percentage basis, the implied going forward yield goes down as values go up. That may be going the other way here very shortly.
Okay. We have some more questions coming in. I don't want to get sidetracked from the presentation, but we'll make sure.
That's okay. Maybe let's hit this one from Brian, if you're good with that, Jeff.
Okay.
We had a bet, by the way, how long this would take to come up.
That's all right. The liquidity status is clearly an area of focus, especially in light of Blackstone and Starwood's B-REIT and S-REIT. Is there an observed difference among ODCE managers about levels of selling? For example, would most managers have sold, say, 2 to 4% of assets in third quarter versus higher or low levels of selling?
Yeah. So, I think, and we'll get in and we'll show the actual math and the answer to that in a minute. I think Blackstone and Starwood, I will obviously respect the not talking about managers specifically, given the, they're not here to defend themselves. We do that with ODCE. We'll do the same with them. They're part of our institutional market as well. But I think that in general, the non-listed REITs, it was covered well. I mean, it's part of their structure. It's what they do. It was well publicized how it works. And it's a little different market. It's a different structure. It's a different investor base, largely today, at least. And it's different assets. So a little different strategy. So we'll certainly talk, though, about liquidity and kind of how those differ. So I'll make sure to hit on that.
Well, that question is from Brian Bode, by the way. Sherry Santos West has a question. How often and how much of their portfolios do ODCE managers have appraised annually? Wondering if this may skew the valuation.
So 100% of ODCE is appraised annually, and every quarter at least a desktop is done, and is largely kind of a full rolling of 25% of the portfolio quarterly. They're all a little bit of nuance to it, but in general, and we'll talk more about values in a minute, but in general, it is appraisal based, and so I think the big debate is: do we want appraisers projecting values going forward, or should they be looking at kind of spot pricing and what it was? And I think that's a big disconnect. So we'll talk more about that with Qs, but it is being appraised. And I think some of the cash flows are going to surprise you when we go through it here in a minute. I see we have another New York question, Jeff, on office. Maybe let me jump into, because I have a slide on that specifically.
How long will office be hurting in cities like San Francisco, New York City? Foot traffic has a lot foot traffic is a lot lower than leaseholds, is the question. Is that something you're going to handle on your slide?
I'm going to talk about pricing and values. In terms of the American people and how fast they want to come back to New York or San Francisco, I don't have a great crystal ball on that. I think everyone talks about it. I think you look at these cities and they've been restrictive, right? They've been slower to come back. This year has been great because I've been able to see a lot of these cities. And it's a stark contrast to going somewhere like in Austin or, a Southern Florida market. They're busier than ever. So I think it is a very wide kind of have and have not, just like kind of a lot of things we're seeing today. And I think that's actually a really good segue into performance, Jeff, if maybe delve into that.
Okay.
So you've seen me talk about this chart before. This is showing the best performing property type versus the worst performing property type in any period. In prior quarters, I've been talking about how high it was. It was over 4 standard deviations at the peak 2 quarters ago. So something we really have never seen in the modern era, at least since 2000. And it really shows you the wide have and have not of performance and sector and views of growth.
Is it manager expertise? Is it portfolio composition, overweights, underweights? What is driving it?
No, so this is just simply saying, over the last year, office had a slightly negative return and industrial had basically a 40% return. So it's not, this is not manager, if you will, quote unquote, skill. It's just the sector.
I was misreading it. I was thinking.
Yeah. But that does lead into the fund dispersion, right? So same concept, best performing ODCE fund versus worst performing ODCE fund over trailing 1-year periods. And again, you can see it's been incredibly high, but this is not without precedent for that. So the volatility, if you will, of funds has been really high. Some have performed incredibly well. Some haven't performed as well. But that's similar to what we saw in the great financial crisis. So we started asking ourselves, why? If you look at kind of the financial crisis in 08, 09, the sectors didn't get nearly as volatile, but the funds were. And when we look back, again, what we saw was it was in the financial crisis, it was all about asset selection, meaning did you have really high quality assets that were well leased with credit tenants, and was the manager good at buying assets and holding them through a recession? What we've seen this time around to date, and I'm not saying this will continue, but in this part of the upcycle of these high historical returns we've seen over the last kind of 2 years, it's been just primarily about getting the right weightings in your fund. So were you overweight industrial primarily, an apartment a little bit, and other? If you had the right overweights in your fund, it almost didn't matter what asset you owned as long as you owned the right type of an asset. We think that will start to change. We're seeing evidence of that already, where the quality and the manager skill is going to, at the asset level, is going to come into play a lot more. I got a quick question from George Dabney about hotel investments. I think there's like 3 hotels in the index so far anymore. So I frankly, I don't have much of a view on that, George. Sorry. But, again, we'll talk about that with other a little bit. I think the market has determined hotels are a bit too volatile to really be in a core portfolio. Nothing wrong with that. Not saying it's not a good asset. It's just not necessarily accomplishing what they want to accomplish in, these open-ended funds.
Right.
So, I kind of mentioned we'll talk about values. I wanted to kind of just hit on two things, the difficult sectors first. So retail, we started to see a bit of a leveling out at least of retail, and we're back to kind of negative values again, slight negative values, in the retail sector. Again, I think we saw a lot of that already take place really, pre-COVID and through COVID. Everyone's favorite topic, office, where's it going? Is it overpriced? Where are these caps? We'll start with, we were seeing some value decline, through the kind of peak of COVID, if you will. And then some moderate appreciation. And now, I think, again, we're starting to see that more value decline. Most would probably say not enough. But I'll give you some food for thought on that in a minute. In total, though, over the last 3 years, I kind of want to look at going into COVID, where were values and what have returns be, after that. The reality is, if you look at the pre-COVID peak to present, the lighter shade of each sector, industrial, and again, this is unlevered asset level. Okay, so industrial has gone up 75%, while the ODCE market as a whole is up 20%. I mean, think about that return difference over 3 years. I specifically unannualized the number because I wanted to really show you, industrial, if you add leverage, has arguably doubled in value, in your holdings. While office, on the very far right, is down on a levered basis, probably over 5%. So, while we feel like the market has been going up, and it's been a great return, all things are not created equal. Office has not appreciated in value since COVID started. In fact, it's depreciated slightly. Again, not arguing it doesn't need to go down more or not, but I think you see the wide value gap that's been created over the last few years. And then to add to that, I'll just show you, again, I mentioned 3 years, the dotted black line is showing you ODCE office as a whole, indexed to 100. But this kind of ties in with that CBD question versus, not all ODCE office is New York City and San Francisco high-rise office. In fact, most of it is not. So when you look at performance, you can actually see the suburban office, which I think we would argue is actually probably benefiting from people leaving the cities, has actually done okay on a relative basis to what you think has happened, in some of these bigger cities. Again, not all real estate is created the same. Not all assets perform the same. So you can kind of see how that changes pretty quickly.
Okay.
So question here, Jeff.
Hold on a second. Question is, with the significant return dispersion between industrial and office, what factors would contribute to a manager outperforming ODCE when the portfolio has been materially underweight industrial and material overweight office?
Again, I think I just kind of showed a quick example of subsectors matter, right? So if you were in suburban office and not, CBD office, and I think I just mentioned, right? Not every asset performs the same. So there are instances where these assets, specific buildings, perform a lot differently, right? And that's kind of the point of real estate. And I think that's what is so, in a way, sometimes frustrating to investors in real estate, It does not all act the same. But, the index as a whole, you can see trends and you can see, weighting differences.
Okay.
Valuation. So I thought it'd be a good time to take a step back and just look at, where are we with values? What's happened over the last, quarter with marks? We saw basically flat returns overall for the quarter, 0.3% positive return, but that was really because of income. Values as a whole went down slightly because going in cap rates went up, modest 9 basis points, but it started. Exit caps again went up a modest 9 basis points, but the exit cap is pushing closer to a 5, which I think is positive. And then finally, discount rates are moving as well with the risk-free rate, up 17 basis points for the quarter and up to a 6.2 total, across the index. What I thought was interesting was, one, exit cap and discount rates grew the most in industrial because they're starting at the lowest basis. So as we think about values, I think it's really, important to think about, where that risk-free rate is. And I think once we kind of have a view on where that levels out or where that equilibrium is, I think will give us a lot better idea on where these cap rates and other valuation metrics should be. But, right now, I think the appraisers are having the hardest time, they've had in a long time. They don't want to just come in and just make broad blanket, changes because, again, they don't know the difference. They're trying to look for real facts to change some of these assumptions going forward.
Now, James Freeman, I think Brian Thomas may be answering this in writing, but James Freeman said, I believe NFI is defining office subsectors in healthcare, life science, medical office building, which has performed well, implying that the broader CBD office subsegment has performed worse than it would appear on the surface. Is that true? Is healthcare, life science, and medical office building part of office, or is it part of other?
It's mixed is the short answer. One of the challenges is these are somewhat newer sectors. It is a little different, in that people are paying attention to it more. So, so it's not well defined. If we look at it, if you were to kind of say all of those others that are in office, take them out, it'd be a little worse for sure. And if you put them all back in, it'd be a little better. But it's not a meaningful percentage. If you think about other being 7%, half of that is self-storage, so you're down to 3.5%, and a very small percentage of that is these kind of office subtypes. So it's not a big piece yet.
Now, here's another question. Can you access data on lease lengths within the index? Almost 3 years post-COVID started, it would be interesting to know the average unexpired term on CBD office. Is there anything like an impending wave of expires that will force decisions?
Yeah, Brian's been looking at that and kind of looking at average leases. I think he can probably send me that number, but it's surprisingly, there's a surprising amount of duration still left, in those leases in office. I'm going to say something closer to the 5-year mark still. So no, we haven't seen any, huge kind of cliff at this point. But it is something to think about. I think, debt's the other thing people are talking about, and I'll touch on that in a minute as well. Jeff, I kind of covered this, right? The risk-free rate. What I think is interesting is, I do believe the bond market is pretty good at least viewing risk and getting, worried about risk early. So, if you look at the single B spread, it's actually, so rates are higher, obviously bonds adjusted faster. And that gray line is showing you the single Bs are actually coming very close to historical average in spreads again, which would kind of imply there's not a lot of credit, or at least there's average credit risk, in the bond world, that they're not overly worried about defaults. The real estate cap rate is clearly well below historical average and spread to the 10-year. So two things can change. Cap rates can go up, or yields, 10-year yields can come down. But I think it's kind of fair to say somewhere between where they are today and that black line is where they should probably be. The kind of last point. Oh.
Everybody's worried about them going up. Do you think they will?
I'm sorry, Jeff. Everyone's worried about what?
Cap rates rising. Do you think that's going to happen?
Yes, I think that they are going up. They went up in the third quarter very slightly, but they moved. And I think they'll continue to go up, to a degree. I think growth can offset that, which is great. Unlike a bond, right? We can have growth of income. And that's why, real estate has done well so far, is that income has been really strong and growing. And we'll talk about that with inflation. But I think, you can't have a 10-year treasury that looks like it's going towards 5, according to the Fed. Whether you believe it or not, that's the question, right? But it's at 3.5 today. And so I think cap rates should probably be a little higher. The question is how high, and I think that's where investors are saying, look, I would like some liquidity if I can get it, because that's where I believe it's going up. But that's also where we see lack of liquidity, because most people can see that. Here's the cost of debt, like I mentioned. The cap rates went down through 2021 into early 2022 because cost of debt, moved almost 100 basis points. That was meaningful cash flow availability to investors. And again, you can see how quickly that's moved back up to right where we were pre-COVID. If we go back to pre-COVID, cap rates need to go up about 70 basis points. That would imply probably somewhere around a negative 10% return. Now, the question is, do we really move back to that level? Income will offset that, all kinds of things, right? But I think that's what everyone's trying to figure out today. I mentioned debt maturity too. So, here's that debt maturity. It's very small. You can see, roughly 10% per year, over the next 4+ years. So, again, that impetus that there's going to be all this distress, that there will be forced selling. I don't see it in this core market, right? I mean, it may be in other assets and other holders that are highly levered. But in many ways, these funds and these managers are also saying, look, it can lead to opportunity. We could see good, good assets to buy at good values. But again, I just don't see a lot of bargain basement pricing here, because they're, while debt's more expensive, it is available. And these funds have very low leverage.
Most of that debt, all of that debt is fixed rate versus floating, or is it a mix?
Yeah, great question. So it's most of it is fixed at this point now, but I want to say about 20% floating, 80% fixed.
Okay, and the floating tends to have a shorter duration, yes?
Yeah, so the floating I think is kind of 1 to 5 year, and the fixed is kind of 5 to 10 year. So switching gears a little bit, I mentioned inflation and rising NOIs. I thought it'd be kind of interesting to look at the trailing inflation numbers. So CPI, inflation. The blue line is what you typically hear about with the 1 year. The lighter blue or teal line is the trailing 6 month. And I thought it was really interesting when you overlay ODCE NOI growth on that kind of 1 year basis. You see, it was severely impacted with COVID. Values did not adjust much, even though arguably, fundamentals did quite a bit. But then you see it kind of really came roaring back through 2022. And we've seen really strong NOI growth, surpassing inflation because, housing, is a big part of that. So, housing is on the pie chart here, housing is a little over 40% of that CPI calculation. And then on the right, if you look at how it's reacted, you can see, I was really surprised. I mean, it's up there, medical care is the only one you really go, wow, it's really given, Medicare a run for its money. And, we all, I think, see that, being runaway, costs. So housing is actually continuing to be pretty strong. And that's again where I think this inflation number could be a little more sticky than we think. All right, Jeff, everyone's favorite, capital flows. We'll get into cues here. We'll start with actual capital flows here, kind of talk about acquisitions, dispositions at the asset level, and then kind of end it with cues, because that means, that's capital that is sitting there either trying to get out or in. So actual flows, you see in the dark kind of blue and gray lines, you can see those are the dollars that actually were either called and flowed into the ODCE funds, and the gray is the actual dollars that flowed out. So these are real cash flows, and you can see they remain quite robust. So, you had on the outflow side, close to $5 billion of outflow. And then on the inflow side, you had close to $6 billion of net inflows. So I think the question was, is it more than 5%? Without doing the math on NAV, I think, it's not 5%, but, it's pretty close, pretty significant cash flows. And by the way, what really surprised me was it was a net positive flow in this quarter. In terms of what was bought and sold, you can see, though, both acquisitions and dispositions are down kind of quarter over quarter. 4Q is usually actually a really big quarter, but I think it'll probably be smaller than 3Q on an acquisitions side for sure.
Big quarter for acquisitions, big quarter for dispositions, or both?
Yeah, usually both in the fourth quarter. So I think, when we look at this, there was acquisitions totaled almost $4 billion during the quarter, and then dispositions totaled about $1.5 billion during the quarter. And one of the questions, Paul.
Let's go back one slide because we've got some questions.
Sure.
First is from Paul Florilla. He says, why is there so much more trading now than ever before? So again, these are just absolute dollar amounts. And if you think about in 2000, the whole index was 30 billion. Today it's 350 billion. So the dollar amounts are just a lot bigger. The market's a lot bigger. The dollar amounts are bigger. And then secondly, these are cash flows. Real estate's a high cash flow business. So, on its face, it should be about 4% income per quarter. Some of that gets sent out to investors. Some of it gets reinvested in funds. But it's cash flow and it's real cash moving around. So that
is picked up in these numbers. And it's picked up.
James Freeman has a qualifying question. Does net positive inflow imply that managers are reducing distributions?
I don't think that alone implies managers reduce distributions. I think you see the number went down from the prior quarter. You know, it peaked in second quarter there in gray, and it came down, you know, in the third quarter. So I think that it's accurate that cash flows came down, but the net positive was, I think they did more buying than selling as well.
And Oliver Cohen asked a question. Any idea what's behind the inward net flows into the index? It's just so contrary to everything out there in terms of sentiment. And Brian actually answered it in writing. He said part of it is reinvested capital RIP that's automatically invested each quarter. Yeah,
and I think you got to remember too, I mean, real estate doesn't trade overnight, right? I mean, a lot of these acquisitions and dispositions are deals that were agreed to even in the first quarter, maybe, of the year, right? When the market looked substantially different, people put, you know, hard money down, so they tend to complete these transactions. But some of this is just a lag effect as well, just from timing.
And does that explain the question that John McClellan asked? Why is there such a difference between cash flows and the acquisition disposition slide?
Yeah, that's right. It really is that lag in planning for liquidity and redemptions. You know, I think, you know, the question is how going forward, how much is sold to, you know, kind of pay for redemptions, which we'll talk about in a minute here. From a transaction standpoint, I think groups like to see, so what was sold was kind of interesting this quarter. It was led by industrial, actually, but, you know, in a way that makes sense. It's the most liquid asset, really. It's the most attractive, arguably. So a lot of industrial, apartment, and then you certainly see retail, office, other. There was only one office deal in the market this quarter, so don't read a lot into that. Acquisitions, again, a lot of industrial, more industrial is bought than sold, though. Other was the second most acquired, and within other, that was really self-storage. About $450 million of self-storage was acquired in the quarter. And then, you know, I should actually mention this. There were 6 retail assets that were sold. So again, not a, you know, not a trend creating view, but of all those 6 assets were sold above a carrying value. So I thought that was kind of interesting. The office was not above carrying value.
Rob Mills had a question related to, again, the flows. Any estimate on what percentage is resulting from DRIPs versus actual new commitments, new money coming in?
Oh, yeah. You know, so I would tell you DRIPs less than 0.5%, you know, of income. So, you know, I would tell you it's a pretty small percentage of that, but, you know, in the scale, I'd have to do the math. It, you know, it does add up. So, I don't know, maybe somewhere around $1 billion, maybe. Mm-hmm. Probably less. Mm-hmm. All right, last one. So redemption queue and entrance queues. You can see here, largely in blue, the entrance queues were largely drawn down to fund those acquisitions I just mentioned. So very little entrance queue remains in the index, you know, really less than 1%. And this is on NAV. So less than 1% of NAV is available to invest or draw. And again, that's concentrated in a few funds. It's not, you know, equal weighted across everything. So there is a very kind of have and have not bias here. The second thing is on the redemption side, you know, we saw wildly different payouts in the third quarter. So, you know, everything that wasn't paid but due in the third quarter went to increasing that red line, which is now over 6% of NAV. And this is since COVID. Again, this is over that COVID timeframe. So any dollars that were in queue pre-COVID are not counted here. So that number would be a little higher if it was.
And what was the redemption queue during GFC as a comparison?
Yeah, so during the GFC, it peaked over 15% of NAV. And again, it looked somewhat like this. I mean, you see how quickly it kind of flip-flopped even between redemption queue and entrance queue and kind of 2Q, 3Q of 21. What we saw was redemption queue went up to 15+%. The market started to recover, and it literally went from like 15% to 2% in 2 quarters because investors said, oh, well, we're clearly in the recovery side of things. I don't want my money. I'm going to rescind. And then entrance queues went up to about 14% as other investors try to get back in. So, these can be pretty, these can really change really pretty quickly.
James Freeman asked, what is the long-term run rate percentage for redemption queue?
So what long-term run rate percent for, that's a great question. It varies wildly across the market and by fund. So, I was mentioning in the third quarter, we saw payouts anywhere, on the extremes from 100% to basically 5% of the requested amount. Now, a couple of things. One, largely those 100% payouts came from, matching entrance queue to exit queue only, right? So that's what drew down some of that entrance queue at some of those funds. Secondly, there's widely different sizes of these funds and the investors requesting money, right? Some of the big funds can have $500 million plus investors, so those are much bigger movements potentially than, a smaller fund with $100 million average client or something. So it really, I'm not sure the averages will make a lot of sense. We can look at that, but it can vary really widely.
Okay, John McClellan asks, how much trading of ODCE shares happen on the secondary market?
Great question. A little bit. We've been active in that space. There is largely a discount. It's not a very, I'd say it's not a very clear market. So I'm not going to kind of get into discount numbers, but it's clearly there. It's bigger than COVID. I guess I'll say that. We're seeing much better discounts than we did in COVID. But it's not a lot of buyers or sellers at this point until people figure out the direction.
Nick Tremontana has a question. Post third quarter 22, I've heard redemption queues on average are up 20% of third quarter NAV. Are you hearing the same?
So as a percentage of NAV, Nick, maybe you can clarify for me if you would. Up to 20% of 3Q NAV. Look, there are individual funds that can have higher redemption queues for sure. But across the market, no. We're at 6% across the market. So if you look at an individual fund, I'm sure you've seen that in a place or two.
He said thanks. Brian Dolvin has a question. Of the 26 funds in the ODCE Index, how many are meeting redemptions on a pro rata basis?
Virtually all. There might be one outlier, but it's basically pro rata and it's by quarter, with the idea being not to create a stampede to the ATM with the first one winning. It just doesn't matter. It gets queued per quarter largely or month.
So what's the dollar amount of the redemption queues right now?
We don't quote that number, Jeff. So this is the kind of way we view it.
Okay. If somebody had the NAV, they could calculate it by just
I mean, yeah, it's math. So, Jeff, as usual, that's kind of my end. Any other questions? Happy to answer. I think we actually had a lot of questions this time, so we only have a few more minutes. If there are any more questions.
25 questions asked this time, so that's amazing. Great interaction with the audience, and that's what we love to see, because that makes sure that we're getting to the issues that we care about.
Yeah. By the way, I was corrected slightly by Brian. Walt in office is about 6 years, so just a little more than I actually said it was.
Okay.
All right, are we? Oh, Patrick Pembroke asked, what's the average cash position on a percentage basis in the NAV across ODCE? Yeah, it's low. 2 to 3% is probably a good guess, but not more than that. It could even be a little lower.
He said, thank you. That's good.
Well, Jeff, as always, it was a pleasure. I really enjoyed doing this. If people have questions, if you sign up, a small reminder, if you sign up for this presentation, you will get the pitch book or the presentation book, that we sent out. If you should see that in the email in a few days as well.
Along with the recording. So you've got good ways of referencing this material. You want to share it with other people in the company, can do that. So thanks for tuning in. And next quarter will be the 2022 year-end report. So don't miss that. Oh, wait, there's 2 more questions before we sign off completely. Oh,
and Jeff, I'll remind you, we did just film the, just ODCE overview as well for those kind of new to the space. That should go up soon, hopefully, just kind of more of a broader ODCE overview.
Great. Yeah, we've been working on that for quite some time. So that's particularly for those people who are in the private wealth advisory marketplace who may not be familiar with what NCREIF really is all about or what ODCE is really all about. It's kind of a primer for all of you. So spread the word, let other people know about it, because it's really going to be a useful tool for people to benchmark the recommendations they're making.
Well, thanks again, Jeff.
Thank you, Garrett. Thanks for tuning in, everybody, and we'll see you next time. Take care.